For millions of Americans, the dream of higher education has quietly transformed into a financial nightmare. What was once promoted as the golden ticket to opportunity is now shackling entire generations with debt they may never escape. The United States has over $1.7 trillion in outstanding student loans, a burden that grows larger every year. Unlike most debts, these loans are almost impossible to discharge, even in bankruptcy. In practice, they follow borrowers for life. This system wasn't inevitable. It was built. Over decades, policies shifted, tuition costs soared, and easy access to credit made it possible for colleges to charge more while students borrowed more. The result? A trap disguised as opportunity. What makes this especially insidious is how it mirrors systems of control throughout history. Instead of chains and labor camps, today's educated workforce is bound by interest rates and repayment schedules. Young adults who should be building wealth, buying homes, and starting families are instead writing checks to lenders, often for decades. This is why many have come to call student debt a form of modern slavery. It doesn't steal freedom with whips and walls, but with contracts and compounding interest. And just like in history, the system benefits a select few, while millions carry the weight. The story of student loans begins in the mid-20th century. After World War II, the GI Bill gave millions of returning soldiers access to higher education, fueling economic growth. College was affordable, often just a few $100s per semester. But by the 1960s, the U.S. government began directly intervening, creating federal student loan programs to expand access. The intention was noble. No one should be denied education for lack of money. But unintended consequences followed. Once federal loans became widely available, universities realized they could raise tuition endlessly, knowing students could simply borrow more. In the 1970s and 1980s, tuition inflation began outpacing family incomes dramatically. Meanwhile, protections for borrowers weakened. In 1978, Congress passed a law making it harder to discharge student debt in bankruptcy. By the 1990s, it became nearly impossible. This meant that unlike credit card debt or medical bills, student loans were inescapable. Borrowers carried them for life, no matter what happened: illness, unemployment, or financial disaster. At the same time, universities built luxurious campuses, administrative bureaucracies ballooned, and for-profit colleges exploited the system. The costs rose, but the safety nets vanished. The result? A perfect financial trap. Students were told education was the only path to success, then offered easy credit to pursue it, while laws guaranteed lenders would be repaid no matter what. What started as opportunity turned into obligation. College used to be within reach for the middle class. In 1980, the average cost of a 4-year degree at a public university was just over $10,000 in today's dollars. Today it exceeds $100,000, and at private schools, the number can double or triple. This surge wasn't accidental. Easy access to loans created a feedback loop. Universities knew students could borrow more, so they charged more. To attract applicants, colleges invested in stadiums, high-tech gyms, and fancy dorms. Luxuries unrelated to education, but justified by endless borrowing. The cost of professors didn't rise tenfold, but administrative costs and non-academic spending did. Families, convinced by decades of messaging that a degree was essential, accepted the price hikes. And lenders profited. Unlike other markets, there was no pressure for costs to stabilize, because government-backed loans guaranteed repayment. The risk was socialized onto the borrowers, while profits were privatized. Meanwhile, wages for young graduates stagnated. A degree no longer promised prosperity. Many left college saddled with tens of thousands in debt, only to earn modest salaries that made repayment a lifelong struggle. This was the quiet trap. Prices soared while value declined. Borrowers didn't realize until it was too late that the system was rigged against them. Student loans are unlike any other debt. A borrower can lose a house to foreclosure, or a car to repossession, but student debt clings even if you declare bankruptcy. Interest compounds relentlessly. Many borrowers find that years of payments barely dent the principal. For those who fall behind, the consequences are severe. The government can garnish wages, seize tax refunds, and even withhold Social Security checks from retirees. Student debt is a creditor with endless reach. This permanence makes the comparison to slavery resonate. Freedom is not only about physical mobility, but also about economic choice. A generation of Americans is bound by contracts they signed at 18 or 19. long before they understood the consequences. They cannot escape, and their future labor is essentially pledged to lenders. Worse still, these debts disproportionately affect vulnerable communities. First-generation students, minorities, and low-income families often borrow the most but have fewer resources to repay. The system widens inequality rather than closing it. This isn't just personal misfortune, it's structural. The U.S. economy itself has been reshaped by this debt. Homeownership rates among young people plummeted, family formation was delayed, and entrepreneurship suffered. A society built on innovation and mobility now finds its youngest adults immobilized. If borrowers are the slaves, who are the masters? The answer is layered. Private lenders, servicing companies, and the federal government itself all profit from the student loan machine. For decades, banks made billions issuing federally guaranteed loans. Even when borrowers defaulted, the government covered their losses. Servicing companies, tasked with collecting payments, added fees and penalties, ensuring balances grew larger. Today, the government itself directly holds most student loans, earning interest from millions of Americans. Universities are also beneficiaries. With guaranteed student access to credit, colleges face little incentive to control costs. Rising tuition fills administrative coffers, funds construction projects, and pads salaries for top officials. Politicians, meanwhile, use the system to score points. Promises of forgiveness or reform become campaign slogans, but meaningful change rarely occurs. The status quo enriches too many stakeholders. This web of interests ensures the system endures. The enslaved class of debtors continues working, paying, and hoping, while the institutions above them thrive. The cruelest aspect of the system is how it disguises bondage as freedom. Students are told loans are an investment in themselves, a path to independence. In reality, they trade youthful optimism for decades of repayment. This illusion persists because the system needs it to. Parents urge children to borrow, counselors say it's normal, and society frames debt as a rite of passage. Only after graduation do many realize the weight of the chains. Yet, unlike past systems of bondage, student debt doesn't provoke mass resistance. The chains are invisible, hidden behind monthly statements and online payment portals. Borrowers continue working, paying, and hoping for relief, all while their choices remain constrained. This quiet control reshapes society. Debt discourages risk-taking, enforces conformity, and locks people into traditional career paths. A nation that prides itself on liberty has created an educated class too financially burdened to fully exercise it. Every system of bondage in history eventually reaches a breaking point. The question is whether America's student loan system is approaching its own. Calls for reform grow louder every year. Proposals range from interest rate caps to outright cancellation of federal loans. Some argue for restoring bankruptcy protections, giving borrowers a path to escape. Yet resistance remains fierce. Opponents warn of moral hazard, claiming forgiveness rewards irresponsibility. Universities lobby to protect tuition flows. Lenders and servicers fear profit loss. The debate rages while borrowers continue to suffer. Still, cracks are appearing. Younger generations are mobilizing politically, making student debt a key issue. Economic pressures, from delayed homeownership to declining birth rates, highlight the system's destructive ripple effects. Even Wall Street is beginning to recognize that crushing young consumers with debt undermines long-term growth. The future isn't certain. The U.S. could double down, keeping millions trapped, or it could reform, loosening the chains. History suggests that no unjust system lasts forever, but waiting for collapse is costly, in wasted talent, delayed dreams, and broken lives. Student loans were sold as tickets to opportunity. For too many, they became shackles. Whether the nation breaks those chains or continues tightening them will define the financial freedom of an entire generation.